Good morning to you all. Bonjour. Je suis ravi de vous accueillir au nom du cabinet Valoris Avocats. I'm very happy to welcome you all on behalf of Valoris Avocats. And welcome to Piotr also, who will present himself in a while. We are happy to make this presentation on the tax structuring of French investments in Poland. This session will be held in English, but you are free to ask your questions in French if you'd like. I will translate it if needed. You may ask the questions via the chat box or the question box, and we will answer the questions after the presentation. As a matter of introduction, let me present you Valoris Avocats first, who, for those of you who don't know us, we are a law firm, a full-service law firm based in Paris, Lyon, Strasbourg, and Geneva. And for our international clients, we rely on a broad network of best friends established abroad. Among these best friends, we are very happy to have Penteris, based in Warsaw, in Poland. And we are ranked in World Tax, Legal 500 and Chambers, as well as the French Décideur ranking. And our law firm counts about 30 people based in our offices in France and in Switzerland. This being said, Piotr, the floor is yours.
Thank you. Good morning. Thank you for joining our webinar. My name is Piotr Prokocki. I am a tax advisor and an attorney at law at Polish law firm Penteris. We are a medium-sized law firm located in Warsaw, around 40 people, and we concentrate mainly on real estate, M&A, and energy sector. We provide tax and legal advisory services mainly for foreign investors conducting investments in Poland. We also rely on our network of law firms cooperating with us in other jurisdictions. And today I would like to talk to you about the structuring of investments in Poland from French perspective. Before we go to the topic, a few words, a few general information about the Polish tax system, and then I will concentrate on the tax structuring of the investment process. We'll start from the very beginning, so from the moment when we decide on financing the investment with debt and capital, till the very end of the investment when we decide on distribution of profits in a form of a dividend payment or in any other way, for example, as a result of liquidation of the company. So let me start with the general information on the Polish tax system. In Poland, we have two types of income taxes: corporate income tax, which is taxation for companies, and personal income tax for individuals. We have indirect taxes. The most important one is value-added tax and also excise tax. And so we have other taxes, for example, civil activities tax, which arises also at tax structuring, at any M&A activities. We have real estate tax and tax on means of transport. When it comes to personal income tax, the most typical method of taxation is tax scale. This method applies, for example, to employees in Poland. And we have three thresholds. The total annual income, which is not exceeding 30,000 zlotys, so this is around 7,000 euro, is exempt from personal income tax. And then in the second threshold, so between 30,000 zlotys up to 120,000 zlotys, so around up to around 28,000 euro, we have 12% personal income tax. And the highest rate of taxation is 32%, which applies to individuals with income exceeding 120,000 zlotys. So this is around over 28,000 euro. We have also additional tax, which is 4% for some types of income for individuals exceeding 1 million Polish zlotys per year. So this is the tax scale, but we have also alternative ways of taxation of individuals. We have flat rate tax, which is available for some individuals, for example, individuals who are entrepreneurs, who work on B2B contract, and this is a 19% flat rate tax applicable to those individuals. And we have also lump sum tax available for some individuals and for some types of income, for example, for income from renting of real estate. And lump sum tax is tax levied on the taxable revenue, so with no possibility to recognize any tax deductible costs. But the tax rate is more preferable compared to the tax scale or compared to the flat rate tax, because the tax rate in lump sum tax differs from 2% up to 17%. And when it comes to corporate income tax, the standard tax rate in Poland is 19%. So 19, and so if we have a company who generates profits, there is 19% on the taxable profits generated by the company. Then if we want to make any dividend payment, we have again 19% personal income tax on the part of the individual receiving the dividend payment. So if we calculate the effective tax rate, so this 19% corporate income tax plus 19% personal income tax, of course calculated on lower tax base, the effective tax rate is 34.39%. But there is also alternative additional tax rate in Poland of the corporate income tax, which applies to small companies, to so-called small corporate income tax payers. And to be qualified as a small taxpayer, the company must have revenues which do not exceed the equivalent of 2 million euro. This is the annual threshold. So companies which taxable revenue do not exceed 2 million euro may apply the reduced 9% corporate income tax rate. So this is 10 percentage point lower compared to the standard one. In case if we have any dividend payment conducted by the small company to individuals, the personal income tax rate on the dividend payment is the same as in case of big taxpayers. So this is 19%. So we have 9% corporate income tax plus 19% personal income tax. But in this case, the effective tax rate is around 26.29%. If we calculate the 9% of the corporate income tax plus 19% of personal income tax. And the standard VAT rate in Poland is 23%. In case of some services or goods, we can apply we can apply VAT exemption or reduced rate, for example, 8%, but the standard one is at 23%. And now we'll concentrate on the main topic of our today webinar on taxation of the investment process. And we'll start with the financing of the Polish company when we decide on to finance company with debt and with equity. So if we want to finance the company with equity, we can consider to conduct a cash contribution, a contribution in kind, and the object of the contribution in kind may be an OPE. This is a shortcut of an organized part of an enterprise. This is a concept defined in the Polish tax provisions. And to present it in simple words, if we have a company with an enterprise, if we can separate a part of that enterprise which may potentially operate as an independent enterprise, we call it an OPE, an organized part of an enterprise. And the object of the contribution in kind may be also the whole enterprise of the company or other assets. And we have to choose which way of financing, which way of contribution will apply, because the taxation will depend on that object of the contribution. If we have a cash contribution to the Polish company, it will not cause any taxation in corporate income tax or personal income tax. So it means that if we have a company which contribute cash to the Polish company, there is no generation of the taxable revenue on the part of the company which contribute cash. So the company or individual contributing cash to the Polish company acquires shares in exchange for the contributed cash, but those shares are not treated as taxable revenue for that individual. And we have taxation with civil law activities tax, but this is 0.5% on the amount by which we increase the share capital. So usually the typical way of structuring of such investments in Poland is that the majority of the cash contribution is allocated to the share premium, and only a small part, 10% or even only 1%, is allocated to the increase of the share capital. And in this case, the 0.5% civil law activities tax is calculated on very small basis. If we have the second option, so contribution in kind of an organized part of an enterprise or an enterprise, such contribution is fully exempt from civil law activities tax. So even if we contribute all those assets to increase the share capital by the value of the contributed assets, we do not have any obligation in civil law activities tax. And such contribution is also neutral for corporate income tax or personal income tax purposes. So if we have an individual or a company contributing assets to the Polish company, which acquires shares, newly issued shares in the Polish company in exchange for the contributed OPE or an enterprise, the value of those shares does not create taxable revenue for the investor. And the third option is a contribution in kind of other assets which do not constitute OPE or an enterprise. And in this case, we have 0.5% civil law activities tax, but we have also taxation with income tax. In terms of the civil law activities tax, we can again decide on the allocation partially to share capital increase and partially to share premium. If we allocate only 10 or 9%, 10 or 1% of the contribution to the share capital increase, so the 0.5% civil activities tax will be calculated on very small basis. But in case if we contribute assets which do not constitute an enterprise or an organized part of an enterprise, then we have taxation with corporate income tax or personal income tax, depending on the status of the investor. So, for example, if we have an individual who contributes such assets and that individual or the company contributing assets acquires shares, newly issued shares in the Polish company in exchange for the contributed assets, the value of those shares is subject to corporate income tax or personal income tax. Of course, if we look at this from French perspective, and if we have a French individual or French company contributing assets to the Polish company, and if the Polish company will not have a status of so-called real estate company, I will later explain what does it mean. So in this case, such contribution also will be neutral because we will generate taxable revenue in Poland, but based on the double tax treaty between France and Poland, the income generated as a result of such structuring will not be subject to tax in Poland. The only exception will be if we have a real estate company in Poland, because transfer of shares, also of newly issued shares in such company, is generally subject to tax in Poland. And a real estate company, called also as real estate rich company, is a company which assets consist mainly of real estate. Of course, real estate is located in Poland, not in any other jurisdictions. So we have summarized the ways how we can contribute cash or assets to the company. And of course, if we decide on financing of the company, we usually choose financing partially with capital and partially or even mainly with debt to create the possibility to make the deduction of interest and to deduct the tax base in Poland. And the typical structure applicable in many jurisdictions and also in the past in Poland is that push-down structure, which actually does not work in Poland now. So to present you that push-down structure, usually we have such a situation that if we have a French investor and a foreign investor who wants to buy a company in Poland, such investor set up an SPV in his jurisdiction, for example, in France, and that SPV is financed with debt. This debt, this loan may be from the bank, but maybe also from any related party of the company. And then this SPV uses this money, which is from the loan, so the principal amount of the loan, to pay the acquisition price to the seller. So the money are used to acquire shares in the Polish company. So the second step is the payment of the acquisition price and transfer of shares from the seller to the French company, to the French SPV, which incurred the debt from the bank. And then the third step is the merger. In this case, will be cross-border merger between the Polish company and the French company. If we meet all the conditions to make the merger in line with the European Union directives, this cross-border merger may be neutral for French and also for Polish tax purposes. So this step may be neutral, and the effect will be that we have a merged company with which is a Polish tax resident, and the company is obliged to pay interest to the bank. In this example, we have interest to the bank, but it may be also interest payable to the related party of that company. But in Poland, we have tax provisions which do not allow to deduct those interests from a tax base. So if the principal purpose of the loan was to incur shares in the Polish company, and then the interest may not deduct the tax base of that company which was acquired. So this is an obstacle, and thanks to that, to this provision, we may not, because of that provision, we may not apply such debt push-down structure. In the past, it was typical in Poland, but now we have to think about alternative structures. One of the alternative structure where we can use this effect of deduction of interest is acquisition of an enterprise or acquisition of an OPE, organized part of an enterprise. So in this case, if we have a French investor who wants to buy a business in Poland, in this case, we have to decide on acquisition of an enterprise of OPE, so acquisition of assets. In this case, we have to conduct the transaction in the form of asset deal instead of the share deal. In this case, we can we can set up a new SPV in Poland. That SPV may be financed with debt incurred from the bank or from the related party, from Polish or foreign bank, or from a Polish or French related party of that company. And even if the principal amount of the loan is dedicated to acquire a business in Poland, but in the form of the asset deal, in this case, we can deduct interest from the tax base. It has also an additional advantage if we conduct a transaction in the form of an asset deal in Poland, because in this case, we can easily cut off the historic tax risk of that business. We have a special procedure in Poland. We can apply for specific certificates which allow us to cut off from the history of that business. And acquisition of OPE or an enterprise is not subject to VAT, but is subject to civil activities tax. And we have to apply two tax rates, 1% civil activities tax on the value of material assets, of tangible assets, and 1% on intangible assets. So 2% on tangible assets and 1% on intangible assets. It seems it is not a very high level of taxation, but we have to bear in mind that in comparison to VAT, the civil activities tax is not refundable. So this is the cost of the company of the investor acquiring business in Poland. So this is one structure which is quite typical in Poland, especially on the real estate market. Now it's we see very rarely that there are investors who wants to buy, who wants to conduct transaction in the form of the share deal. Usually such transactions are conducted in the form of an asset deal. And the second way which allow us to use this effect of interest deduction is acquisition of company with existing debt. So we have such a structure that we have a French company, French investor who wants to acquire a company in Poland. And we have a company in Poland which is actually financed with debt, with a loan from the bank or with any other debt. And in this case, we acquire a company with existing debt, so the debt is not repaid before the transaction. And then we continue financing of the company with that debt, or we make refinancing after the transaction. And in this case, the Polish company may deduct interest from the tax base because the purpose of that debt in this case is not the acquisition of shares in that company, because this debt usually exists before the transaction. So this is one way also where we can use this interest deduction effect. And in such structures, the acquisition price is usually very low because we have to decrease that price, decrease the value of the company by the amount of the debt which is financing the company. So we had such transactions, for example, an acquisition of big real estate located in the center of Warsaw, and the value of those real estate was around 20 million zlotys, but the price was around even around €1, because it was actually the price was the assumption of debt financing the company. Such structure has also an additional advantage in Poland, because if we reduce the value of the company by the amount of the debt financing the company, which we assume as in the course of the transaction, so in this case, we also reduce the tax base for the civil law activities tax, because normally acquisition of shares of the Polish company is subject to 1% civil law activities tax payable on the part of the investor, on the part of the acquiring company or acquiring individual. And in this case, this 1% is calculated on a very small amount, because the value of the company is decreased by the amount of the debt financing the company. Of course, there are also some other structures used in the Polish investments, but those two are visible very often in the recent time. So investors are trying to find alternative options to this debt push-down structure, which will allow them to use debt financing and deduction of interest. In those structures that I have presented, in those two alternative structures, as a rule, we can deduct interest from the tax base. But of course, this deduction is subject to many limitations, as in any country. And the first limitation is, of course, fin capitalization limitation. Now we have fin capitalization provisions in Poland, which are mainly based on the ATAD-3 directive. ATAD-1 directive, sorry, and we have two limits. So the one limit is 3 million zlotys. So if we have debt financing costs which do not exceed 3 million zlotys per one company per year, all those interests may be deducted from the tax base. And the second limitation is 30% of so-called tax EBITDA. So the company has to calculate its tax EBITDA. The methodology of this calculation is based on the ATAD-1 directive. So this is a unified methodology for all European Union countries, also to French investors. And then we calculate 30% of that tax EBITDA, and we can apply this limitation. And each company may choose which limit is higher for that company and may apply the higher limit in a given year. The second limitation are the tax provisions based on the hybrid mismatch limitation. These provisions are based on the ATAD-1 and ATAD-2 directive, Anti-Tax Avoidance 1 and Anti-Tax Avoidance two directives, and those provisions are unified in the European Union. So I hope they are in the same shape in France.
They are.
And
Yes.
okay, thank you. And the third limitation are transfer pricing rules. And transfer pricing rules. So if we want to apply this interest deduction effect, if we want to deduct interest from the tax base of the Polish company, those interests have to be established at arm's length level. Of course, if we talk about interest payable to related parties, we have to follow transfer pricing rules. So we have to prepare a benchmarking study, which verifies the arm's length level of interest payments. If we have interests which exceed the market level payable to related parties, the amount exceeding the market level will not be treated as tax deductible cost. In Poland, we have also one alternative way to verify the arm's length level of interest. If we have loans financing Polish companies incurred from related parties, but if the principal amount of those loans do not exceed 20 million zlotys, so around 4.5 million euro, in this case, we do not have to prepare a benchmarking study, which is usually to some extent an expensive exercise, but we can apply a safe harbor regulation, which says that if we base our interest on Euribor or some other indicators, and if we establish the margin which is indicated by the Polish Ministry of Finance, then we have an assumption that those interests are at market level and they may be treated as tax deductible cost. And now let's switch to the distribution of profits. Of course, the most popular way to distribute profits is dividend payment. If we don't want to close the company, but just to transfer profits from the Polish company to the investor. And the good information is that if we transfer profits from the Polish company to the French company, usually we may apply withholding tax exemption based on the parent subsidiary directive and on the Polish corporate income tax provisions implementing the parent subsidiary directive. To apply this withholding tax exemption, we have to meet certain conditions. One, the most important condition is that we must have a French company which holds at least 10% of shares in the Polish company, and the shareholding period may not be less than 2 years. Of course, we can apply this exemption even before the lapse of the 2 years, but then we have to wait at least 2 years to keep the right to apply this exemption. If we, for example, interrupt the connection between the French company and the Polish company before the lapse of the 2 years, and we do not have this shareholding, then we are not allowed to apply withholding tax exemption.
The same applies. Sorry, Piotr, for interrupting you. The same applies at the level of the French company, of course, for the dividends payments which are received by this French company. It's a mere application of the parent subsidiary directive, as you mentioned rightfully. So we would have corporate income tax exemption in France for the dividends received by French company, subject to the limitations you have mentioned. So in that case, the cash repatriation would be neutral.
Yes, so we are on the same page. So the cash repatriation from the Polish company to the capital company in France will be neutral. And I don't know how is the attitude of the French tax authorities now, but in Poland, even if it is not directly stated in the parent subsidiary directive that one of the conditions to transfer profits is that the French company should be the beneficial owner of those profits. But in Poland, the Polish tax authorities say that if we want to make such a transfer, we may not have, of course, artificial structure, and the French company should have a status of the beneficial owner of those payments. So this means that it may not be a company which is legally or actually obliged to transfer these payments to any other entity, any other individual immediately after receiving those profits from the Polish company.
We have the same anti-avoidance rules in France as well. Yeah. So French investors should be familiar with this rule.
Yeah, so from perspective of the French investor, I think it will be not difficult to create the conditions to this neutral transfer of money. Of course, the situation comes more difficult if we have multinational structure and if we have above the French company any entities from outside of the European Union or any entities from tax havens. So in this case, it will be more difficult. But from the Polish perspective, the Polish tax authorities in this case would concentrate on the verification of the business substance of the French company to verify whether this is not a letterbox company or shell company. And if we have a company with proper business substance, which has some assets, employees, office, or any other real estate, so in this case, the transfer should not be a big problem. And of course, if we have transfer of profits through dividend payments, we may not conduct any deduction of tax base in Poland, because we have taxation in Poland with this 9 or 19% tax, depending on the size of the company in Poland. And then the transfer is neutral. But if we want to make a deduction in Poland, we have to look at any other payments, for example, interest payments already mentioned, and royalties. I have told you about the limitations on the deduction of interest payments. The royalties may be also deducted from the tax base, of course, if they are payable to the French company, which is a related party to the Polish company. In this case, the remuneration for those royalties have to be established at arm's length level. So again, we have to follow transfer pricing rules. And in this case, of course, we have to think about withholding tax, because as a rule, interest payments and royalties are subject to 20% withholding tax in Poland. But again, good information is that if we make such payments to capital company in France, and if we have a connection between the French company and the Polish company, then we can apply withholding tax exemption based on the interest royalties directive and the Polish tax provisions implementing that directive. One of the conditions to apply the exemption is that the French company should have at least 25% of shares in the Polish company. It may be also connection in vice versa. So the Polish company may have 25% in the French company, but if we look at this process from the French perspective, so if we have Polish subsidiary, the French investor should have at least 25% in the capital of the Polish company.
In this respect, I would just like to add that interest deduction or royalties deduction is a good thing, of course, but one should consider that the corporate income tax rate in Poland is 19%, if I understood you correctly, Piotr, and it's currently 25% in France for mid-sized company, let's put it that way, and it's likely maybe we will have an increase of this tax rate for big multinational companies in the coming months. We'll see. But at least for the time being, we have 19% deduction in Poland and 25% taxation in France. So interest deduction or financing via interest in Poland might not be a good idea from a mere tax point of view.
Yes, so if we have such, thank you, Guillaume. We have such structure only with French and Polish companies, so this will not bring any tax benefit on the taxation on the group level. As I mentioned, in Poland, we can also have this 9% corporate income tax in case of some small companies, so the difference may be even bigger. In case of interest and royalties payments, we have the condition to apply the withholding tax exemption, the condition of the beneficial owner of payments. And this condition is directly stated in the interest royalties directive and in the Polish tax provisions implementing interest royalties directive. And one more thing about the beneficial owner of payments. In Poland, we have a Polish domestic definition of that concept, which is not typical in other countries, because this is a concept of international tax law. And this Polish definition sometimes makes some problems, because apart from the legal and from the legal conditions, so the beneficial owner is an entity and a company or individual who is not legally or actually obliged to make any transfer of payments, is not any intermediary which is obliged to transfer payments to any other entities. We have also additional requirement in Poland to be qualified as a beneficial owner. The company must have business substance, must conduct a genuine economic activity. So this condition may not be met by many holding companies which have very little business substance, which do not have any employees. Of course, some holding companies may have business substance, but they must have some employees and assets to be qualified as beneficial owner. And in Poland, if we make any payments subject to withholding tax, so dividend payments or interest or royalties, we have also a very unpopular mechanism, which is a pay and refund mechanism. This is contrary to the relief at source approach. In many countries and also in Poland, in the past, we used to only to apply the relief at source. And the relief at source is that if we have a Polish company which conducts payments subject to withholding tax, that company acting as a tax remitter has to verify the conditions on application of the exemption from the withholding tax on its own, or the conditions to apply the reduced rate of the withholding tax, and then can make the decision to apply that exemption or application of the reduced rate on its own. And the pay and refund mechanism is the contrary. Even if we verify that we have met the condition to apply withholding tax exemption or the reduced rate of the withholding tax, we have to collect the withholding tax with application of the standard tax rate, and then we have to apply for the refund. The good information is that the pay and refund mechanism does not apply to all payments conducted by the Polish companies. It applies only to payments conducted to related parties and only to so-called passive payments exceeding 2 million zlotys per year. And this limitation is, this threshold is applicable to payments conducted to one related entity within one financial year. And those passive payments are dividends, interest, and royalties payable by Polish companies to foreign companies. So the excess over 2 million zlotys is subject to the standard withholding tax, which is 19% in case of dividends and 20% in case of interest and royalties. In such a case, the Polish company has to collect the tax and has to apply for the refund. The tax authorities have 6 months to conduct the refund, so this mechanism has negative influence on the cash flow of the company. And we have two alternative options. We can apply for so-called clearance opinion. This is a special kind of a tax ruling in Poland, and that clearance opinion allow us to do not apply the pay and refund mechanism to payments covered by that opinion, and that clearance opinion is applicable for 3 consecutive years from the moment when it is issued for the company. The second option, which we do not recommend, is signing a statement by the board member of the company. And this withholding tax statement is quite a risky solution because it may create a risk of fiscal penal liability on the part of the board members. So this is recommended only in the case if we have very clear situation and if we have no doubts as to whether we can apply the withholding tax exemption or the withholding tax reduced rate. And we have also another limitation applicable to interest payments, but also to other so-called passive payments, which are called shifted profits, which are conducted to French company, to any other company. This is additional 19% tax on so-called shifted profits. But to apply this additional tax, those shifted profits must be at least 3% of tax-deductible expenses of the Polish company, and must meet other criteria. They must be conducted so-called dormant entity, so company which generate profits mainly from passive sources. They must such passive payments must create at least 50% of the revenue of such company. And I think there will be no applicable to French companies, because this solution is applied only to if we conduct payments to companies which effective tax rate is lower than 14.25%. So French companies are subject to 25% corporate income tax, so this will not be applicable. And we have also one exemption which is applicable to French companies and to any EU companies. If we have a company who is recipient of such payments and that company conducts a genuine economic activity in any EU member state, in this case, we do not have to apply the tax on shifted profits. So I have told you about the limitations, about the difficulties. One more difficulty is minimum income tax, and then I promise we'll switch to the incentives for the investors. The minimum income tax is quite new concept. Now we have the first year of application of that tax in Poland. And this tax is applicable to companies which have very low profitability or which incur losses in Poland. So if we have a company which incurs tax loss in Poland or which has profitability lower than 2%, we have to apply minimum income tax. And this minimum income tax is 10% of the tax base, which is the calculation of the tax base is quite complicated. But to simplify it, to calculate the tax base, we have to take 1.5% of the revenues, of taxable revenues from other sources than capital gains. This is one part of the tax base. The second part are debt financing costs exceeding 13 thresholds specified in the corporate income tax. And the third component are cost of acquiring of intangible services or intangible rights from related entities or from entities from tax havens. But of course, if those costs are exceeding some threshold specified in the Corporate Income Tax Act. This tax base is subject to further deductions, but I don't want to concentrate only on that topic. So we have to think that if we set up a company in Poland, if the company will incur losses or will be with very low profitability, then we may have this minimum income tax. But we have some exemptions from this tax. For example, the first exemption is applicable to new companies, to startups for the 3 first years of the operations. And now we switch to the incentives, which are offered by the Polish tax system. The first very popular incentive is so-called Estonian corporate income tax. The Estonian corporate income tax is widely applied in Poland since 2022. So this is quite new solution. It is applicable to all companies, so to small, medium-sized, and even for big companies. But usually it is not available for international corporations, because to apply the Estonian corporate income tax, we must have very simple structure in Poland. So we must have a company which shareholders are only individuals. And in this case, we have a tax benefit, which is a postponement of taxation till the moment of the distribution of profits. So if we have a Polish company which generates profits, and then those profits are distributed, we have the tax obligation at the moment of dividend payment or at the moment of distribution of profits, for example, as a result of the liquidation of the company. We have some specific events which also creates obligation of corporate income tax payment, like, for example, so-called hidden profits. But as a rule, we have the postponement of taxation till the moment of the distribution of profits from the Polish company. And the second advantage of Estonian corporate income tax is deduction of personal income tax payable by the shareholder. And in this case, we can deduct the effective tax rate, so the corporate income tax plus personal income tax, from this mentioned 34.39% to around 20.83% or to 25%, depending on the moment when we make this payment of profits, distribution of profits. Of course, the second advantage is available for shareholders who are Polish individuals, who are Polish tax residents. So if we have French individuals using this solution, we'll have only the first advantage, so the postponement of the taxation till the moment of the distribution of profits, because the second advantage based on the Polish income tax, Polish personal income tax, and the individuals who are French taxpayers, of course, are not subject to the Polish personal income tax. So this is the first incentive. The second incentive, which is also very popular in Poland, but for medium-sized and big companies, is Polish investment zone. In Poland, we used to have for many years a special economic zone regime, which is actually coming to the end, and we are now replacing this regime with the Polish investment zone. The Polish name is Polska Strefa Inwestycji. And the exemption, the benefit in this solution is the exemption from the corporate income tax. The amount of the exemption depends on the amount of the investment. So the popular structuring in that way is that we have a foreign investor who, for example, built land in Poland and buy land in Poland and built manufacturing plant in Poland, and then the amount of the investment is decreasing the corporate income tax. So we have so-called Polish investment zone assets. And that asset is calculated as a percentage of the amount of the investment in Poland. The percentage depends on the location of the investment in Poland. So in some regions we have higher percent, in some regions we have lower percent. The highest percent is 70%, so 70% of the money invested in Poland. So we multiply the amount of the investment by the 70%, and this is the amount of the exemption from corporate income tax. And this exemption may be used for a period in the first years of operations, but for quite a long period of time. This period also depends on the location in Poland, but the shortest period is 10 years, and in some regions it is even up to 15 years, so much longer than the period of investments applied by the investment funds, which is usually from 5 to 7 years. And we have also a tax incentive dedicated to IT industry and to all other industries which are engaged in R&D activity. We have R&D relief, which is double deduction of costs incurred for R&D activity. So, for example, if we have an IT company or any company which has R&D center, if that company hires employees, if that company incurs other expenses for the R&D activity, those expenses may be normally deducted from the tax base, but in this case, they may be deducted twice. So this is the first incentive, and the second incentive is IP box, and the IP box is the reduced only 5% income tax, which is applicable to revenues from sale of intellectual property rights. So if we conduct R&D activity and if we create any so-called works, so then which are qualified as intellectual property, and then if we generate any profits from that intellectual property, those profits will be subject only to 5% income tax. And because of this solution, for example, we have a very good situation in the IT industry, have many software houses in Poland, because they widely use those two tax incentives, which may be combined and which may effectively decrease the tax rate payable in Poland. So those were the most typical incentives in Poland. And at the end of the presentation, I would like to say about a few words about how to secure the tax position in Poland, how to secure those incentives, and how to secure the position against the tax risk in Poland. So the most popular instrument in Poland to secure the tax risk is applying for individual tax ruling. The tax ruling is issued after 3 months from the application, and in Poland, the tax rulings are very popular in all cases where we have a situation which may be interpreted in different ways by the tax authorities. We usually apply for the tax ruling to secure our position. We have also a specific kind of tax ruling, so-called binding tax rate information, to verify the, for example, VAT rate, which should be applicable to specific goods or services. We have also specific tax ruling, which is called clearance withholding tax opinion. Already mentioned, this clearance opinion allow us to do not apply obligatory pay and refund mechanism in case of passive payments conducted to related entities. As in many other countries, we have advanced pricing arrangements. So this is an instrument for transfer pricing regulations, which allow us to officially confirm the market level of any payments conducted by the Polish company to the related entities. And the most advanced kind of tax rulings in Poland is so-called protective opinion, protective tax ruling. And this protective tax ruling protects us against the application of the general anti-avoidance rule. The general anti-avoidance rule was introduced to the Polish tax system in 2016, so over 8 years ago. And the general anti-avoidance rule, GAAR, allow tax authorities to question tax benefits if we have any artificial structuring, any artificial transactions. So the definition of this rule says that an action which does not result in obtaining a tax benefit if, under given circumstances, achieving the tax benefit which is contrary to the subject or purpose of tax act or its provisions was the principal or one of the principal purposes of the execution, and the methodology used was artificial. So this is defined as the tax avoidance. So if we create any artificial structure, if we create any artificial steps to avoid taxes in Poland, even if based on the technical provisions we can create any tax benefit, the tax authorities may question that benefit, even without questioning the civil consequences of the actions taken by the company or the individual. And to protect against the potential application of this general anti-avoidance rule, we can apply for so-called protective opinion. This is a much more advanced instrument compared to the tax ruling. It takes at least 6 months to have such opinion, and the official fee payable for such opinion is much higher compared to the tax ruling. So in these ways, we can secure our position in Poland. So if we think about structuring in Poland, to guide you through this labyrinth, we usually first prepare an opinion. We will prepare a memorandum together with our foreign colleagues. And then if we have any situations which raise any questions, how they will be interpreted by the tax authorities, we usually apply for the tax ruling or for the advanced tax ruling, which is a protective opinion, to secure the position of the investor and the position of the Polish company. So we are slowly coming to the end. Thank you very much for your time, for the participation in our webinar. I give the floor to Guillaume.
Thank you very much, Piotr, for this insightful presentation. If there are any questions, please do feel free to ask them. Vous pouvez aussi poser les questions en français. There's the question box at the bottom right of your screen, or the chat. You may use it as well. I think that Poland, from a tax point of view, is a very interesting country. We have a lower tax rate as in France. We have very innovative tax systems. You have explained to us the Estonian tax system, which I find very charming. And there is the downside of we can't do the debt push down. if acquiring a company. Well, we can do it, but it doesn't work the same way it would do in France. But that's no big surprise. It's the case in some countries, and with the help of qualified partners like Penteris, we're able to put efficient tax structuring in case of an acquisition of a Polish company. So that's not a no-go at all. And besides, it might be interesting to keep the debt at the level of the French company. So this being said, that's not a problem. And we also saw, thanks to you, Piotr, that Poland is a very secured tax environment, thanks to the tax rulings, etc. we have just seen. And the IP system is quite interesting as well. So thanks a lot for that. If there are no questions, you may send us your questions after a while if you'd like. You will receive the presentation, the PowerPoint presentation, and you will have access to the replay as well. We will send them to you shortly. And as a matter of information, we will have also webinars in the coming weeks and months on Germany, on Luxembourg, on Italy, and other countries to follow. So, stay tuned. We will keep you informed. And meanwhile, if you have any interest in investing in Poland, our best friends from Penteris are here to help you, and so are we.
Once again, thank you for the participation. If you have any questions, as mentioned, after the presentation, we'll be more than happy to discuss with you those questions to provide you the answers. And if you consider any investment in Poland, investments are popular not only on the real estate market, but also in the manufacturing market, for example, because of the nearshoring trends. So in this case, Poland may be a very good option for French investors, because it's not so long distant from France, and still we are in the European Union. So in this case, I think based on our connections with Valoris, we can create an effective structure which will be effective from tax perspective, but also safe structure which will not create any tax risk, which should not arise in case of such investment. So thank you once again, and I think we wish you a pleasant week. Thank you for starting this week with us.
Bye-bye. Au revoir.